Well, the Dow dropped for the 8th straight day. That's occurred 6 different times since 1982, and in each one of those instances, the Dow Jones was up 3 months later. So for those of you hitting the panic button right now, don't be so sure. Maybe this is a time to buy the dips. What we do know is that the S&P 500, the NASDAQ, and the Russell 2000 all are displaying bullish intermediate confirmation signals after today's pullback in price. We also saw some big news out of the Supreme Court, actually involving my home state of South Dakota, which you don't hear about in the news too often. But anyway, that did affect a lot of online retailers today and then kind of carried through to some of the brick and mortar retailers. So I want to kind of focus on that as our trade application example for today. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's June 21st, 2018. If you're new to these videos, first of all, welcome aboard. We're grateful to have you in our audience today. Remember, you can subscribe on YouTube itself. You can also give us a thumbs up and also leave a comment if you so desire. In the description area, you'll find a link to our emailed list, which will entitle you to receive an email daily whenever we post these videos, and also will give you a heads up on which stocks are showing overbought and oversold cluster signals in the S&P 500 each day. In addition to YouTube, we're also heavy users of Twitter. My handle is @BrandonVanZee, all one word. The Market Scholars handle is @market_scholars, and we'd welcome you to join us there. We do usually pin the tweet that contains the Market Outlook information to the top of our timeline, and we'd encourage you to click like and retweet if you get value out of these videos on a daily basis. We also have a presence on Facebook, so for those of you that are on Facebook, feel free to jot down that web address on the logo in front of you. That'll take you into our group. All right, with that, let's go ahead and do some analysis on the markets here. As you can see, I've got the S&P 500 pulled up in front of us. It actually shows a reasonably interesting pattern right now. We've got kind of a couple of bullish indications here, so let me explain. As you can see, the market itself was down 17 points today. That was a fairly good sized candle. As you can see, the size of that candle fairly strong there. In fact, I think David was mentioning in last night's video how very few of the candles recently have had more than a 0.5% move either up or down. So this one would qualify as one of those, down 0.6 in this particular case. Well, the reason that it looks somewhat interesting from a bullish perspective or a buy the dips perspective is that, of course, we still have the bullish posture. Remember, we've had a bullish posture since this candle right back here, and that's why the background color of our chart changed green at that point. That's when the intermediate term line started trending higher. That's your green line down below right here. So anytime that's trending higher between 20 and 80, we consider that bullish. Anytime it's just simply above 80, like it has been since basically May, let's call it 10th, that we would consider bullish as well. So we know that we have this bullish posture going on. In combination of that bullish posture, notice what's happening here today down below on the market forecast indicator. We have this red line that's in the lower reversal zone. That red line is what you'll hear us refer to as the momentum line. And remember, you can kind of track those current positions from a point perspective over here on the chart itself, on these labels, as you can see that I'm kind of pointing at with my mouse. Now, for those of you that are premium Market Scholars subscribers, you're welcome to follow along with us during these presentations on your own Thinkorswim platforms if you've gone through my video tutorial that I make available for all of our premium subscribers. This just happens to be chart 4A here in this case. Well, when we look at this momentum line in the lower reversal zone, sitting at 16.89 right now, and that's combined with a bullish intermediate line, we call that a bullish intermediate confirmation signal. And if you want to think about it in simple terms, it's kind of a buy the dips mentality where we still have a strong intermediate term trend. Remember, that's what the green line is telling us, but we have a momentary pullback in price, and that's what the red line is telling us in that lower reversal zone right there. Now, where we like to see the blue line positioned is between 50 and 20. And you can see right here, the blue line, which is called the near-term line, is at 48 currently. So it does just barely fit within that range that I mentioned a moment ago. So not that that's a guarantee of anything. It's just that we've noticed, generally speaking, the bullish intermediate confirmation signals that have the blue line position in that area tend to work out a little bit better over the long haul. So as you can see, that's an interesting setup. And in addition to that, we also have price touching that 30-day moving average. Now that hasn't happened since this candle right here on May 29th. That's the only time you've had that opportunity to basically get into the market around that 30-day moving average in this entire bullish run since that day. So I think that's kind of an interesting setup where you'd have to believe the Dow Jones at some point is going to get a bounce day. 8 days in a row is not very normal for any market, let alone the well-established Dow Jones Industrial Average. So if the Dow does bounce from these levels at some point in the next week, then you would assume that the S&P 500 would kind of carry along with it. So anyway, I think that this area right here, if you're looking to place bullish trades, could make some sense as we see if we can bounce off of that rising 30-day moving average, and we currently have that bullish intermediate confirmation signal as well. Notice that the market sentiment line, which we do have plotted on this same indicator down below, it's the orange line that's plotted with a dotted line there. We don't talk about it a lot, so that's why we don't really kind of emphasize that line, but that's for the really long-term posture, and that continues to trend higher. So that's another positive element of this overall market. Let's now take a peek at our chart 4B, which is our foregrid, and this is where we look at all 4 of the major US indices on the same chart setup using that market forecast idea as far as looking at postures. Remember what I mentioned on Tuesday, which is the Dow Jones right now is the only one of the 4 major indices that has a bearish posture. So, it's interesting. We've received some emails here recently that suggest that talking about the Dow Jones is a waste of time. I guess everybody has their opinion. In this particular case, I find the Dow Jones actually somewhat interesting, considering it's the only one that is showing something different than the rest of the market. So it is finally worth talking about. Oftentimes you find that these indices do basically the same thing as one another. So the fact that Dow Jones is doing something different than the others actually makes it more relevant now than at any other time that we usually look at this. So right now we remain with a bearish posture on the Dow Jones. Remember, that's telling us a story about the market right now. This is a market that is not willing to give the mega cap companies the benefit of the doubt. At least right now they're not, because a lot of those mega cap companies, of course, are struggling, first of all, because of the strength in the US dollar, which David and I bring up repeatedly during these presentations. In addition to that, of course, we've got all this news about the potential trade wars that are brewing between the United States and China. And of course, a lot of those companies, there's only 30 companies on the Dow, a lot of them do business in China and elsewhere, and so those are the ones that are really struggling right now in comparison to something like the Russell 2000, which we see down below has just been in a significant uptrend, and it again tells us the story of the market. The Russell 2000 isn't going to be beat up by a strong dollar. In some cases, it's actually going to be benefited by that because it gives them stronger buying power when they need to buy materials and products from overseas, and a lot of them are selling their wares here in the United States alone, domestic-only businesses in a lot of cases. So we did see the Russell 2000 pull back. I don't want to make it seem like it's all signals go, but we have to remember the Russell 2000 just got done completing 4 straight bearish cluster signals or overbought cluster signals. Notice this down below, 1, 2, 3, 4. You don't see that very often either. So it's about time it gave back some, but keep in mind, even after today's 1% pullback on the Russell 2000, it didn't even bring us back to where we got the first cluster signal 4 sessions ago, right? On that particular candle that I'm pointing at right there, the closing price is 1683, where we stand right now is 1688. So a lot of you are probably thinking, well, geez, that was a pretty ugly day there, 1% to the downside. Yeah, it didn't even bring us back to where we were trading a week ago. So Russell 2000 has been a stalwart here at this current price. Or this current location. You can see that the NASDAQ hasn't been too far behind. It ticked a new all-time high just yesterday. Today, it did have a little bit more of a pullback. Part of the reason for that is what I mentioned in the intro, which is some of the news affecting those internet retailers, in particular Amazon, remember, is now one of the 5 largest companies in the United States, and so it's going to take more of a precedence in some of these market cap weighted indices like the NASDAQ and the S&P 500. So we'll talk about that a little bit more as we go forward here, but just wanted to point that out, that the FANG stock kind of had a one-day hold here today. Even Netflix, right? Netflix has been acting like it's been Teflon recently, but if I pull up Netflix here, notice that even Netflix pulled back today. Now, Some of you might make the argument that with the bulls actually pushing that up in an intraday basis, it's not as bad as it seems for Netflix, and that very well may be true. Remember, this shape of a candle right here could very well be construed as a hanging man candle. Remember, a hanging man and a hammer look very similar to one another. The difference between the two being the hanging man would be up at a level of resistance, the hammer would be down at a level of support. And so with this one up near a high, we'll see if that leads to further weakness going forward. But Netflix has just been absolutely extraordinary. In fact, we talked about it last night in my Strategy Lab class. For those of you that are premium subscribers to Market Scholars, that's the class where I conduct 50 different trading strategies against one another. I'm trading them against one another to learn things about the market. And in two of the portfolios, two of the three that we covered last night in particular, that were momentum-based portfolios, they're just crushing the market this year. And one of the common denominators between those two is they both had Netflix in it. So for those of you that have been hanging on to Netflix for dear life this year, whether you know it or not, it's really done a lot of wonderful things for your portfolio. Back to the matter at hand here, let's pull up the NASDAQ again. One thing I did want to point out is what I mentioned in the intro, which is if you look at the S&P 500, the NASDAQ, and the Russell 2000, notice that all of them have those bullish intermediate confirmation signals. But it's only the S&P 500 that has that blue line position between 50 and 20. So you might look at the NASDAQ and the Russell as being less than ideal, although still qualifying for that bullish intermediate confirmation signal. Let's take a look at another chart set up here now. Let's go to the 3 green arrows. And as you can see, from a 3 green arrows perspective, where we stand is we have 3 red arrows right now on the Dow Jones Industrial Average. There's red arrow number 1, there's red arrow number 2 on the MACD, and there's red arrow number 3 on the stochastics. When we look at all the rest of the indices, we actually have mixed bags, meaning we have a mix of green and red arrows here. So not a whole lot to kind of interpret from those perspectives, other than this is kind of a transitionary point where we figure out whether we want to continue that momentum higher or whether this is a time where we need to take some time off in the summer doldrums. So right now we have mixed signals on all the rest of them and a kind of confirmed bearish kind of posture on the Dow Jones with the 3 red arrows right there. From a longer term perspective, let's now take a look at chart 4D now. Remember, this is a 3-year weekly candle chart that we're looking at in all 4 of these cases. And what we're looking for here are crossing overs of the moving averages themselves. The orange lines represent the 10-period exponential moving average, and the blue lines represent the 40-period exponential moving average. As you can see, none of those lines are in jeopardy of crossing right now. The one that is the concern, no surprise considering what we just learned here a moment ago, is the Dow Jones. Dow Jones, notice we have a red arrow hanging out above this week's candle. And what that's telling us is that we are crossing below that 50-day moving average right now. Remember, the 50-day moving average and the 10-period weekly moving average are effectively the same thing, so however you want to describe that. So we're crossing there price-wise, but remember the moving averages themselves will lag price, and so it would still take a few weeks even if price did kind of stay down at these levels for the moving averages to cross. At this point, we haven't had any changes in posture on this setup in over 2 years. We've been bullish long-term for over 2 years at this point, and that's why these background colors have remained green for as long as you see them here on the charts. All right, let's do some 12-grid analysis now. Starting with the intermarket analysis here, and as you can see, we got a mixed bag of green and red backgrounds. As a reminder, when we go through these 12-grid analysis here, the green backgrounds will tell us bullish postures using the intermediate term line on the market forecast, and the red background colors will tell us bearish postures. All right, so as we look at this, VIX did have a big day. Notice the VIX was up 14%, so it earned its keep today. And I was talking 2 days ago when I did this presentation on Tuesday saying how, yeah, the VIX was up, but I think it was only up like 7% on that day. It really wasn't that big of a deal, all things considered. Today's a bigger deal. A 14% move is a legitimate move. Look at the size of that candle right there. It's one of the bigger up candles on the board. And remember, that's not a good thing if you want to be bullish on the markets. The VIX and the markets are generally inversely correlated. So premium got a little bit more expensive here day over day. And depending on how your portfolios are set up, that may be good or that may be bad. But just be aware premiums are getting a little bit more expensive. If you think premiums are too expensive and you want to sell that premium, that can be a benefit when you're doing things like credit spreads. So as we look at some of the other charts that are on the board right here, one thing that did catch my eye, muni bonds. We don't talk about this one all that often. It's a quiet, boring area of the market. But you will notice that if you're taking a look at ticker symbol MUB in this case, we had a pretty nice day out of MUB here, and a good sized candle there. Remember, you have to kind of set your expectations accordingly when dealing with bonds. They're not growth stocks, but you will notice that this has been a fairly consistent upward trend starting since this moving average turned green here back on looks like it was May 23rd. So keep your eye on MUB. It looks like money is kind of drifting towards maybe some safe havens right now, and muni bonds might be getting a little bit of an advantage there. As we look at some of the other charts out there, you know, one of the things that does catch my eye is that gold continues to drift lower. I mentioned that 2 days ago as well. We did have a oversold signal here yesterday on gold, but that didn't stop the bleeding. We were down yet another day here. Now you will notice that we had some other cluster signals earlier in the 3-month period that we're looking at on this chart here. Generally speaking, that did call kind of a momentary low. You'll notice after we got this cluster signal, the market did go higher after that, the gold market. And then after we got this series of 3 in a row clusters right here, we stabilized by going sideways, then reverted back up to the mean. Now we stayed in this longer term downtrend, so I don't want to make too much of it, but I do want to point that out because it's entirely possible that maybe we'll start seeing a little bit of stabilization in gold prices around these levels right here. So keep your eye on that. Also keep your eye on the dollar story. Dollar's been so strong here over the last 3 months, you would think that the dollar at some point will cool off. You can see the dollar was finally down here today, so maybe we're getting a little bit of a rounded top up there on the dollar. Remember, if the dollar weakens a little bit, that should add a little bit of support to some of those commodities like gold. Let's take a look at the foreign markets now, foreign stock markets. So as we look at the foreign stock markets here, again, what I'm looking for are key trends or key reversals in trend. Germany has been a house of pain. That's your chart in the lower left-hand corner. I haven't noticed how the German soccer team is doing in the World Cup, but I know they generally fare pretty well. Hopefully they're faring a little bit better than their stock market right now. We were down another 1.4% in Germany here today. Some of you might have caught the news about some of the auto manufacturers and how they've been struggling here recently with some of these tariff talks. And of course, Germany, huge auto market there with, you know, Daimler Chrysler, and we've got BMW and Mercedes and Porsche, and you name it. There's a lot of excellent car companies out of Germany. So they're struggling right now along with that particular theme. Notice the United Kingdom has also been struggling recently, but maybe a little bit of ray of sunshine there in terms of that nice little oversold cluster signal that's showing up on that chart. Remember, if you ever want to blow these charts up to make them a little bit easier for your eyes to see, and of course I'm talking directly to the premium subscribers of Market Scholars right now that have gone through my tutorial to set up all their charts this way, just right click on the chart and go to Maximize Sell. Then you can start seeing this in greater detail, and you can see why we have that oversold cluster signal. We have the green, the blue, and the red lines below 20 all on the same day. It actually is at the same level where we bounced from 2 sessions ago as well, and kind of corresponds with some of these bounce candles that we saw back here in the beginning of April as well. So maybe a little bit of hope that a relief rally could be on the way for the United Kingdom at some point here in the next few days. You'll notice that we did have some bullish clusters or oversold clusters here on Russia a few days ago, and we are already getting that bounce out of Russia. Notice that we already went to a bullish posture, which is actually kind of rare. Let me actually highlight that by right-clicking and maximizing the chart as well. You don't see a situation like this very often where you have 3 straight oversold cluster signals, meaning that the green line has to be in the lower reversal zone, and then see that unwound so quickly that within just 3 days of time, we actually went to a bullish posture. Remember, you would have had to have a bearish posture on these candles here because the green line was in the lower reversal zone, but notice how it just barely snuck out of there. So that's why I wanted to double check that, because even that was surprising to me, and that makes a little bit more sense that we are hardly out of that at all. We're at 20.07, as you can see from the label over here. Remember, it just has to be above 20.00 to be considered bullish. This would be weekly bullish, by the way. But yeah, that's quite rare to see in such a short amount of time for us to have oversold cluster signals to immediately having an intermediate bullish posture. So Russia may be coming to life a little bit there. Keep your eye on that one. China has just been a house of pain as well. Notice that China has absolutely fallen out of bed if you're using FXI as your proxy. Let me right click on that and go to maximize sell here, and you'll notice kaboom to the downside. That's FXI right there. And you can see that we have the green, the blue, and the red lines in the lower reversal zone producing that oversold cluster signal right now. So finally, maybe a ray of hope there for China, because I know a lot of people that have been playing that market have been in the house of pain here recently. Pretty ugly session there, down 2.3% yet again today. Remember when I was talking on Tuesday, we brought up China as well, and that was the gap down day right here that I'm pointing at. So it's been a really, really bad couple of weeks here for folks that are invested in Chinese stocks. We'll see if they can find a little bit of stabilization. Of course, a little bit of good news on the tariffs front might help, but then again, it seems like we've got leaders in both countries that are kind of playing a little bit of hardball with each other right now. So I don't know if I'm going to hold my breath for that to happen anytime soon. Let's see if there's anything else that I want to point out on these particular charts. Not necessarily. Mostly bearish postures across the board for the foreign markets right now. Let's take a look at our U.S. sectors 12 grid now. And here it's a little bit of a better picture, but still mixed bag. Again, we have that bullish posture still in place for the time being on the S&P 500 itself, but do note that it's at 81.9 and falling. So if it falls below 80, that would switch to a bearish posture. So keep your eyes on that. But I think there is at least a reason to be somewhat hopeful with us approaching that rising 30-day moving average right there. Wouldn't be surprised at all to see a little bit of a bounce from those levels. So as you might assume, the 11 other charts that are on this setup outside of the S&P 500 are the 11 sectors of the S&P 500, with the exception of telecom, which is kind of a strange situation where there's only 3 telecom stocks in the S&P 500. So the sector spiders actually put the telecom stocks in their technology XLK product up here. And so this telecom that I'm using down below is outside of that fund family from BlackRock, or iShares from BlackRock. And it does include more than just the telecom stocks in the S&P 500, because it really wouldn't make a lot of sense to have an ETF that would just have 3 stocks in it. So I certainly get that. So this is just used to kind of judge or gauge what's been going on with telecom generally. But as you can see, one of the themes that we do have on the board right now is down at these levels. Speaking of telecom, along with staples, utilities, and real estate. Notice at that bottom level of the grid right there is all green. In addition to that, we have healthcare right up here in green as well. Those are the more defensive areas of the market. Those of you that want to think in terms of stock market cycle, you can kind of see the way that these are ordered on purpose. And so that bottom rung there is your more defensive, oftentimes interest rate sensitive areas of the market. And it's not necessarily a good sign when we see those holding up the best in the market, meaning this. Those are usually where money goes to hide. And so right now we see areas like the consumer staples holding up a little bit better than something like the materials, which, by the way, was the sector that I focused on in my dividend growth investing class that I hold every Thursday at noon Eastern time. So we had an excellent discussion about the cyclicality of the materials space and why it's not generally the best place to be looking for long-term dividend growth investments. There are some exceptions to the rule, but anyway, feel free to check out that recording if you want to hear that conversation. As we look at the various charts out there, joining the defensive sectors, we do have technology and discretionary. Discretionary was down 0.7%, technology down 0.77%, so they both had a little bit of a pullback today, but their postures still remain strong with an intermediate term perspective. Now, do note that the staples are one of our bullish postures, because I want to kind of talk about that with our trade setup here a little bit later today. And notice that the staples were actually up today as well, 0.2%. The utilities were up 0.34%, and the real estate sector was up 0.6%. those were the only sectors that were up today. So again, a more defensive vibe on the day for sure. Let's go over here to the internet here briefly. First things first, for those of you that are still sitting on the fence on whether you want to join David and I at Market Scholars with a premium level subscription, remember our discount offer does end on June 30th. So we don't want people coming back and saying, oh, we never heard about that. You know, that's why we've been telling you more about that here recently. So remember, that is basically a 33% discount versus what somebody's going to be paying on July 1st. So if you're on the fence and you're curious about what the experience has been like for other market scholars out there that have already signed up for that premium subscription, I would encourage you to come to this link here that we've been placing at the bottom of our blogs that contain the Market Outlook videos that will then take you to this kind of link that says, why should you join Market Scholars? And you can hear directly from other students on how they are getting value out of our business and being able to take advantage of our daily classes where we practice application-based investing, meaning we're taking concepts and theories, but we're actually trading based off of them. You know, I got another comment here recently saying, well, you guys don't buy very many long stocks in the Market Outlook videos. And that may be true. We focus a little bit more on the options trading in these videos because we don't really have a good way to exit the trades yet. And options can help protect us because they have a built-in exit since they have an expiration period. But for those of you that do want stock-only ideas, as a reminder, we have plenty of that at Market Scholars. In fact, I teach 2 classes that are fairly popular with our students that are stock-only classes. On Mondays, I teach my top-down trend trading class where we're looking for momentum-based trades based off of the strength in the sectors, the strength in the industries, and then the strength in the stocks themselves. And then on Thursdays, as I mentioned a moment ago, is when I teach my dividend growth investing class, which is a different approach where we're looking for stocks that oftentimes have pulled back in price, but are now presenting us with a very attractive historical yield. Both of those classes are stock only, and we don't talk at all about options in either of those. So for those of you that are interested in stock only investments, we would encourage you to sign up for Market Scholars, and you have access to those classes on a daily basis. All right, the other thing I wanted to point out over here on the internet is on Twitter here. I did post something here earlier today regarding Amazon and something that caught my eye that I found interesting. Of course, Amazon being in the news here today with the Supreme Court decision regarding online retailers and taxation. But notice this, with our new chart setup, which by the way, for those of you that are premium Market Scholar subscribers is now available. I did update that last night. So go back to that chart importation tutorial link that you guys should all have access to and then re-import chart 1A, and that should then be available for you. But this is that relative strength chart that will show the stock versus the S&P 500 versus its specific sector versus the industry. And so Amazon belongs to the discretionary sector. I know that's not always visible on Thinkorswim, but it is visible directly within our ThinkScript that we built by hand. And the industry group that it belongs to is the internet and direct marketing retail. The thing that I found interesting here is that Amazon has actually been underperforming its own industry group since basically February. As you can see with my circles here, this orange line on the chart represents Amazon's relative strength versus the internet and direct marketing retail industry group. And believe it or not, Amazon actually is forming lower highs and lower lows from a relative strength perspective. I personally would not have guessed that, so that's why I find that fascinating and worth bringing up here today as Amazon is in the news. Now, of course, Amazon is vastly outperforming its sector and the market, and that's what that purple and that blue line are telling you there. But from an industry group's perspective only, that just goes to show you how strong some of those stocks like Etsy have been recently, that Amazon can't even keep up with its own cohort there. Now, the other thing that I wanted to talk about, kind of drifting back over here towards the Thinkorswim platform, let me just pull up, in this case, let me pull up chart 3A, which is the dividend stair-step chart. I want to bring up Walmart, because Walmart was one of the stocks that was up today. In fact, Walmart was up today, and so was Target. Notice both of them up nearly 1% here today. So the reason that I find that interesting is, of course, all this news about those retailers and a lot of the online-only retailers getting blasted here today. You know, if you look at Amazon, it was down 1% today. If you look at Etsy, the stock I just mentioned a moment ago, it was down 1% today. If you look at eBay, it was down 3% today. So a lot of those stocks really struggling there, but then we turn it around and find some of the more traditional brick and mortar retailers like a Walmart, like a Target, starting to show some signs of progress in their price here today. So one thing that I wanted to point out regarding Walmart is, first of all, notice that on this dividend stair-step chart, we're almost back down to the level that would be viewed as attractive for longer-term dividend-oriented investors. Remember, when price comes down to this orange line, it means that its yield is at an attractive price compared to itself. So for Walmart, it usually becomes attractive with a yield of 2.67%. Notice the corresponding orange label up at the top of my screen here. In addition to that, you'll notice that its yield, its current yield, is listed over here in the black towards the left here. So its current yield is about 2.47. Its attractive yield is 2.67. So it would need to fall down to about 78 bucks in order to have that. So we're not quite to those levels, but I just wanted to point that out because for much of the last 2 years, Walmart has been in a rocket ship higher and then finally has pulled back this year to a level where it might be viewed as attractive again, because we did have basically 2-year period right here where you did have those attractive yields available to you for anybody that was interested in picking up Walmart, and then it just really took off and got outside the bands of normal valuations for a lot of dividend growth investors. So we're back kind of in that range right now. Let me now come back over here to just a chart 4A and show you Walmart on a market forecast perspective. Notice that the green line actually went up today. That intermediate term line went up, and therefore we now have a bullish posture on Walmart. Now, we don't want to get overly aggressive about this because you will notice that we had a brief period of bullish posture there and there that ultimately failed. But at this point, one of the nice things that's creeping into this chart is we actually have a line of defense set up here with a double bottom right around 82 bucks. And we were able to protect that level in the most recent pullback in price. Notice that we only went down to about 82.38 on that candle that I'm pointing at right there. So it did not breach this prior double bottom that was in place here. And now all of a sudden we're above that moving average and we have a rising market forecast green line there giving us that bullish posture. So what I thought we would do here today is what's known as a credit spread. It's a bull put spread in this case. I've got the July monthly contracts pulled up right here. And what I'm going to do is I'm going to come over here to the 82.50 strike in this case. Notice that that's a delta of about 33 at the current level. I'm going to right click on that. I'm going to go to sell vertical. Now, we already have a stock position in this account here, so this would be adding to additional bullishness here. So again, you just got to be careful with your position sizing. You don't want to overdo it in any one company, but you know, obviously there is at least a reason now with the posture going back to bullish to consider a trade here. Now remember, when I have the 82.50 pulled up down below, I can adjust the bought strike here. In this case, it says +1 at the 82 strike. I'm going to change that to 81.50 instead. Now notice I'm selling the 82.50, I'm buying the 81.50. That's creating a credit of 25 cents over here. If I click on confirm and send, you'll notice that, you know, with just doing one contract, and obviously you'll position size however many contracts you need for your account, but 25 divided by 75, this math will hold no matter how many contracts you have because it's the percentages that we're looking at here, is a 33.3% return on risk, which anything above 30% we're somewhat interested in. And so anyway, this bull put spread will make money as long as Walmart, which is currently priced at $84.21, stays above 82.50 for the next 29 days, the life of this trade. As long as it does that, whether it goes sideways, whether it goes up, or whether it just drifts down a little bit, but as it does not go below 82.50, we should win this trade. So I'm going to go ahead and place that trade. Off she goes, and we'll see how we do with that one. Well, I want to thank you for joining me here today. It's always a pleasure to go to work for you. Interesting day in the market with the Dow being down 8 days in a row. But again, remember that 3 months later, usually the Dow is up after experiencing that type of a pullback. At least that's what we've seen in history since 1982. So we'll see if we can get a bounce here or not over the next 3 months or so. And of course, a lot of those retailers in play right now. So keep your eye on some of those online retailers to see if they can bounce back from today's beatdown or whether this will be a continued theme going forward. So that's certainly a news story to keep your eye on if you are in the retailing space. So with that, I want to wish you all the best with your trades and your investments. Remember that David will be back with you tomorrow. I'll look forward to joining forces with you next week. Take care, everybody. Bye-bye.